Tax audits in Canada are conducted by the Canada Revenue Agency, CRA, to ensure that individuals and businesses are complying with the tax laws and reporting their income accurately. A tax audit is an examination of a taxpayer's financial information and records to verify the accuracy of their tax return. The CRA may select taxpayers for an audit based on various factors, such as random selection, discrepancies in reported information, or specific industries that have a higher risk of non-compliance. If you are selected for an audit, the CRA will notify you through a letter or phone call, explaining the process and requesting relevant documents and information. During the audit, the CRA may review your tax returns, receipts, invoices, bank statements, and other financial records to verify that you have reported your income correctly and have claimed the appropriate deductions and credits. They may also ask for supporting documents for certain expenses or transactions. It is important to respond to the CRA's requests in a timely and complete manner. If you are unable to provide the requested information, it is advisable to communicate with the auditor and explain the reasons for any difficulties. It is also important to cooperate fully and be truthful during the audit process. If the CRA finds any discrepancies or issues during the audit, they may make adjustments to your tax returns, resulting in additional taxes, penalties, and interest. However, if you disagree with the CRA's findings, you have the right to appeal their decision through the appropriate channels. To minimize the risk of being audited, it is important to keep accurate and organized records, report income honestly, claim only eligible deductions and credits, and seek professional advice if needed. In addition to the information provided earlier, it's important to note that tax audits can be conducted for various reasons, such as 1. Random selection. The CRA may select taxpayers for an audit randomly, without any specific reason or suspicion of non-compliance. This aims to ensure that tax audits are performed fairly and that everyone has an equal chance of being selected. 2. Discrepancies or anomalies. The CRA may also conduct an audit if they notice inconsistencies or discrepancies in the information provided on tax returns or if the information provided does not match with other records, e.g., T4 slips from employers. 3. Industry or sector-specific audits. Certain industries or sectors with a higher risk of non-compliance may be targeted. The CRA may focus their audits on areas where they believe there may be a higher likelihood of underreporting income or claiming incorrect deductions. During a tax audit, the CRA will typically request specific documents and records, such as bank statements, receipts, invoices, contracts, and other supporting documents. They may also conduct interviews with the taxpayer or request additional information to clarify any potential issues. It is advisable to cooperate fully with the CRA during the audit process. This includes providing all requested documents and information promptly, responding to any queries from the auditor, and being honest and transparent about your financial affairs. While going through a tax audit can be stressful, it's essential to remain calm and seek professional advice if needed. Taxpayers have rights during the audit process, and there are procedures in place to address any disputes or disagreements with the CRA's findings. 1. Types of tax audits. The CRA conducts different types of tax audits based on the complexity of the taxpayer's situation. These may include desk audits conducted through correspondence, where the CRA requests information and documents via mail or online, or field audits, where an auditor visits the taxpayer's premises to conduct the audit in person. 2. Time frame. The duration of a tax audit can vary based on several factors, including the complexity of the taxpayer's affairs and the specific issues being examined. The audit process can range from a few weeks to several months or even longer, depending on the circumstances. 3. Voluntary disclosures. If you realize that you have made errors or omissions on your tax returns, you have the option to make a voluntary disclosure to the CRA before they initiate an audit. A voluntary disclosure allows you to correct your tax filings and potentially avoid penalties or prosecution for non-compliance. It is important to seek professional advice if you are considering making a voluntary disclosure. 4. Penalties and interest. If the CRA discovers that you have underreported income or claimed ineligible deductions, they may assess penalties and interest on the additional tax owed. The amount of the penalty can vary and may be based on factors such as the severity of the non-compliance and the taxpayer's history of non-compliance. 5. Appealing the audit results. If you disagree with the results of a tax audit, you have the right to appeal the decision. The appeal process involves submitting a notice of objection to the CRA, outlining the reasons for your disagreement and providing supporting documentation. In certain cases, you may need to escalate your appeal to the Tax Court of Canada or other relevant tribunal. Airzol is a leading provider of comprehensive tax solutions. With our team of experienced professionals and cutting-edge technology, we offer efficient and accurate tax services to individuals and businesses alike. From tax planning and preparation to IRS issue resolution, we handle all aspects of taxes with precision and expertise. Our commitment to delivering personalized solutions tailored to each client's unique needs sets us apart. Contact us today at +1 647 232 7909 and discover how Airzol can streamline your tax process and help you achieve your financial goals.